Or there's a second method called the Burr method. Burr! Yeah, not Gucci Man though. This is a different Burr. What's up, YouTube? This is Dillan, Pierre, your favorite real estate professional, coming at you live. If you're new here, I make videos about buying, selling, and investing in real estate. I started this YouTube channel for two reasons. Number one, I wanted to simplify purchasing and selling real estate for those that wanted to get started but didn't quite know how. And number two, provide you that free education so that way you're better equipped when you're out there on the market. Maybe you're a first-time home buyer, you don't want to pay closing costs, and you need assistance. Maybe you're a for sale by owner looking to get above market value for your home. Or maybe you're just ready to start investing in real estate and building wealth by starting a real estate portfolio. Feel free to join me or sit back, hit the like button and watch. Either way, I appreciate you. Today's video, we're going to be talking about how to buy your first rental property. The first thing that you want to do is get a pre-approval letter from your local lender. You can usually get a cheaper loan online by using Quicken Loans or Finance America, but you lose the ability for a local lender to put their reputation on the line and go to bat for you as a buyer. You don't get that type of customer service with the online lender. Talk to your agent because your agent should have a great relationship with the local lender. The second thing that you want to do is find out what type of loan do you need. You have your choice between a VA loan, which is a veteran benefit, usually 0% down and no closing costs. You have another choice between a conventional loan, which is usually 5, 10, or 15, or 20% down, depending on credit. Mortgage insurance is a lot less, but to get rid of mortgage insurance, you gotta at least have the property for 2 years or at least have 20% equity in the property. And the third option is the FHA loan. Slightly lower interest rates, but the mortgage insurance is a lot more expensive. You can also add a non-occupant co-borrower, someone to go on the loan with you to help you qualify for the loan using their income. Anytime you pay less than 20% down, you have to live in the property. You can also get a FHA 203K loan, which is a home buyer's loan for you to renovate the property as you like. We'll talk more about the 203K loan and go into more detail in another video. However, in order to use the 203K loan, you have to buy under 5-unit properties, which is a single family, duplex, triplex, or fourplex. Anything over 4 units is typically commercial financing, which is 35% down or more. You'll hear Grant Cardone talk about that a lot in his videos. You'll also have to meet debt service coverage ratio, which means property is forced to cash flow. The next thing to consider is HOA dues. In my opinion, not all HOAs are good, so make sure you do your research on what the rules are. However, I do recommend HOAs because the property maintenance stays up to date. Now that we have a pre-approval letter, keep in mind the pre-approval letter just means it looks good, sounds good, and it smells good. Things can still go south or sour. What you really need is a formal loan approval subject to condition. Now you have your agent, now you've made your offer, and your earnest money is now deposited. Now during the appraisal, loan, and inspection contingencies, this is the time that you have to bail and change your mind about the house if you decide you don't want it. But if you close on a property and find out after the inspection that there's mold in the walls, the house is now yours. So moving on to the biggest part of being in escrow is the transaction to purchase. Anytime a lender says we need pay stubs, etc., whatever they ask for, get it to them right away as soon as possible. The last thing you want is a delay in the loan process that could cost you more fees, like a rate lock extension. A quick little sidebar about the appraisal myth that a lot of people get misunderstood. The appraisal is going to tell us exactly what the market value is. False. The appraiser is there to do his or her job, which is give his or her opinion. The bank says, hey, this property is worth $250,000. Go check it out and see if the value is at least $250,000. The appraiser is just there to help you substantiate the value for the lender. Market value is what somebody is willing to pay. No one knows that except for the buyer, not the appraiser. A good example of that is if you have someone that really wants the house and the appraiser comes back and says, you know what, this house is worth $250,000. Bank is not going to give you more than $250,000 for this loan. If you got somebody that really wants the house, they could pay more than what the appraiser said the house was worth. The only thing is they got to come out of their own pocket for the extra. So market value is what a buyer is willing to pay, not what the appraiser says the home is worth. Now we're moving on to the closing. Do your final walkthrough and the property is now yours. Remember earlier I said anything under 20% down, you have to live in a home for at least 1 year. So what I recommend my clients to do is to buy the property to live in so you get cheaper interest rates and better loans, then convert the property into a rental property after 1 year. You can rent out the rooms while you're staying in the home, or after a year you can move out and rent the property to another family. Follow and repeat this process over and over again, building a real estate portfolio. Or there's a second method called the BRRRR method. BRRRR! Yeah, not Gucci Man though. This is a different BRRRR, which basically means buy the property, repair the property after 1 year, refinance the property, take the cash out of the deal and repeat. Buy another property, repair the property after 1 year, refinance the property, take the cash out of the property and repeat. Building a real estate portfolio. You could use the rent that you're getting from your first property to qualify that as income to afford the second property. You can get insurance for the property or an umbrella insurance so it covers multiple properties. If you want to continue to get educational videos like these, don't forget to subscribe. If you like this video, consider sharing. And if you've got any value out of this video at all, please don't forget to hit the like button and we'll see you on the next one.